for 2021. Following a 6.9% increase in 2019, the Philippines' GDP fell by negative 8.1% in 2020. The decline was caused by the COVID-19 pandemic. Industry experienced the greatest decline among the three major industrial origins, with a negative 13.2% annual change, compared to a 5.5% annual change in 2019. Philippines per capita gross national income also declined by negative 12.6% from the previous year's 3.9% annual change. Meanwhile, per capita GDP decreased by negative 10.8% from 2019's 4.6% annual change. The Philippines' 2020 headline inflation rate is 2.6% year-on-year. The rate of growth was slightly higher than the previous year's rate of 2.5%. The largest contributors to this trend are alcoholic beverages and tobacco index. Core inflation, excluding selected food and energy items, remains unchanged. Logistics chain issues has been causing supply shocks from late 2020 through 2021, leading to rising inflation. Moreover, election-related spending in the first quarter of 2022 is expected to consumption and inflation. However, inflation is not expected to exceed 3.5% and should subside in late 2022. There were $190 billion in outstanding loans for private capital expenditures from commercial banks and universal banks as of December 2020, which was less than 2019. Loans outstanding have slightly increased in 2021, extending to 2022 as distressed businesses restructure existing loans while banks tighten approvals. The employment rate was 59.5% in the fourth quarter of 2020. Among the three major industry groups, the services group employs the greatest number of people, accounting for 56.9% of the workforce. For the unemployment rate in the Philippines rose to 10.3% from 5.1% the previous year. It is expected to increase in 2021, but have begun easing as the economy opens in late this year. The latest data from the Central Bank of the Philippines showed $6.59 billion of FDIs flowing into the country in the year 2020. Equity infusions primarily came from Japan, Hong Kong, and ASEAN countries, and were primarily invested in manufacturing. For the property market overview, the COVID-19 pandemic caused a massive economic slowdown in most countries in 2020. In the Philippines, many industries had to rethink their business models, and many businesses had to close permanently. The property market was weak due to most office workers working from home or being laid off. There was a record high vacancy rate and a negative take-up rate for the year in Metro Manila. An exodus of Philippine offshore gaming operators, or POGOs, during the year added to the occupancy issues. To retain existing tenants and attract new ones, landlords reduced rental rates and made building improvements. Residential pre-selling take-up reached a new low of 2,612 units in the fourth quarter of 2020, a significant decrease from the previous quarter. Meanwhile, the total take-up for 2020 is 6,977 units. This slowdown is the result of COVID-19's negative effects, as well as lower demand from expatriates, local professionals, and the absence of POGOs. Capital values for Metro Manila residential properties during the fourth quarter fell 6.6% to $4,198 per square meter. Premium 3-bedroom unit rental rates in Metro Manila CBDs fell 4.5% to $15 per square meter per month, down from $16 per square meter in the previous quarter. Demand for office space in Metro Manila plummeted in the fourth quarter of 2020, with office transactions totaling 70,700 square meters. Furthermore, 2020 net take-up was negative at 183,100 square meters. Demand was driven by traditional companies such as e-commerce, fintech, telecom, healthcare, and logistics. In Metro Manila, these firms account for 196,000 square meters of office transactions. Meanwhile, POGOs fell by 91% in 2020 to 48,000 square meters from 554,000 square meters the previous year. The majority of industries have also reassessed their operational efficiencies, resulting in a paradigm shift away from traditional office spaces and toward work from home or hub and spoke models. As a result, vacancy rates are expected to rise further, reaching nearly 10% of total Grade A office stock by the end of 2020. High vacancy rates also had an impact on rates in Metro Manila CBDs, with a 1.5% quarter-on-quarter decline to $23 per square meter per month. Lessors had to lower their rates as a result in order to attract more occupants. Only 425,500 square meters of new office supply was completed due to several building completions delayed as the pandemic impeded construction schedules. And as for the retail sector, there were no shopping malls completed this year. Consumers were encouraged to buy more from online retailers, which reduced foot traffic in physical stores even more. Furthermore, difficulties in the retail sector can be attributed to a slow inflow of remittances from OFWs, bonus cuts, an increasing unemployment rate, and negative consumer sentiment. Real estate developers in the Philippines have decided to continue and complete their mall projects between 2021 and 2023. Among the most anticipated developments are the following. With schedules pushed back, major developers have become more aggressive in their online shopping strategies and services to offset losses caused by load. From April to October 2020, the government imposed travel bans in response to the pandemic, contributed significantly to the decline in foreign arrivals. During the lockdown, majority of hotel guests were returning overseas Filipino workers, frontline health workers, and professionals working in Metro Manila, whose daily commutes were hampered by the suspension of public transportation. As a result, hotel occupancy rates in Metro Manila have decreased significantly. Metro Manila's average hotel occupancy rate fell to 23.3% in 2020. However, hotels gradually regained their footing in the last quarter of 2020 due to lockdown easements. The average room rate in Metro Manila was $45, up 26% from the previous quarter. And the existing supply was 40,200 rooms as of the fourth quarter, with completions only recorded in the first quarter of 2020. For the industrial sector, despite the period's slow take-up for the industrial sector, the average Greater Manila selling price increased by 6.1% to $121 per square meter in the second half of 2020, while monthly rent for existing logistics space averaged $7 per square meter in the same period, owing to the area's growing online retail presence and mobility, which increased overall demand for logistics space. For years, the Calabac corridor has served as the country's primary industrial hub, with Batangas dominating industrial land supply with 30.6% share. There have been no new developments recorded, and the 5 industrial parks that were supposed to be completed this year has been delayed. In contrast, the Greater Manila area saw significant annual logistics space completions in 2020, adding 255,600 square meters to the total existing stock. Laguna is expected to house the majority of new logistics space over the next 3 years. Pandemic restrictions hampered infrastructure rollout in 2020, and spending fell to $17.52 billion or 4.6% of GDP. The Investment Coordination Committee of the National Economic and Development Authority approved 20 projects. Foreign loans or official development assistance were used to fund 19 of the 20 approved projects. Some of the big ticket projects approved in 2020 are the following. Tourism, OFWs, unemployment, and consumer confidence all fell as a result of COVID-19. Despite the pandemic's effects, the real estate industry may thrive. Several office buildings offer lower cost single office rentals for up to multiple occupants. It is predicted that flexible workspace will grow 10% in the next 3 years. Co-working spaces will appeal to multinational corporations, outsourcing firms, small businesses, and digital nomads alike. On the other hand, low-cost housing developments near infrastructure and transportation hubs are expected to be in high demand. Meanwhile, the local e-commerce markets are sprouting up in the industrial sector. Storage, sorting facilities, and irradiation facilities are in high demand. The next wave of growth is expected in Central Luzon and Calabarzon. Finally, after the revised rules went into effect, into REITs to help democratize the real estate market. These allowed small investors to invest alongside large corporations in high-value real estate. Some of the major developers are already offering REITs. Overall, mass vaccinations and optimistic government forecasts are expected to boost the economy by the end of 2021. That's all for the Philippine update, and thank you.